Hello, Keith Lawhorn from the Wyoming Stable Token Commission. Today's conversation is going to be about cross-border payments and comparing stablecoins to traditional wires. We're going to investigate how money crosses borders, compare the traditional payment rails that we've had for the past 50 years with the ones that just showed up about 10 years ago and are now settling trillions in transactions. It's going to be an honest look. It's not a pitch for either side. Both have real failure models. We're going to come up with a decision framework and understand the pros and cons of both. Next slide. Oh, sorry. Next slide. So real quick, my background. I'm the CISO again for the Wyoming Stable Token Commission. We have released the first public entity issued US dollar asset in the United States. As the CISO, I'm responsible for the architecture, the key management, AML, automation, cross-chain security, et cetera, for the issuance of the stable token. I come from the traditional financial rails. As my background, I started off in the Federal Reserve, worked on the first PKI project for the ACH system, moved into commercial banking, insurance, and early e-commerce. I most recently ran a cyber forensics program for HSI, Homeland Security Investigations, supporting multiple intelligence agencies for sanctions evasion and trade-based money laundering. Next slide. Next slide, please. So the agenda, we'll start with what is a cross-border payment, what it actually is, what the costs are, and who the parties are involved. We'll talk about how a wire works, correspondent banking, the SWIFT system, where the time and money is spent. We'll look at how a stablecoin transfer works. We'll do an honest comparison, the speed, the cost, the transaction finality, the risk, and the recourse. Finally, we'll talk about the hybrid stack, a decision framework, and 3 predictions I have. So the hybrid stack is the mix of the two. Next slide, please. A payment is 2 problems wearing one name. One is the movement of value, and the second problem is verifying the permissions. On the movement of value part, you've got multiple parties, multiple currencies, multiple banking systems, multiple legal regimes. On the verifying permission part, is the sender who they claim they are? Is the recipient sanctioned? Is the purpose legal in both jurisdictions? If not, who's responsible for that? No matter what payment process we're talking about, these problems exist. The corridor economy. So, cross-border flows are currently estimated around 190 trillion, and there's some estimates that they'll increase by up to 30% in the next 5 years. Global remittances, so this is a private individual sending money, oftentimes to family across border, is almost $1 trillion at, I apologize. Next slide, please. The global remittances are estimated at about $860 billion, and that is primarily individual to individual. Those remittances, according to the World Bank, cost about 0.3% for an average transaction of $200 in family remittances. That's $12 to $13 to send 200. The UN's Sustainable Development Goals set the target at 3%. So it's more than double the goal for remittances. Next slide, please. Next, we're going to look at how a wire transfer actually works. There's a lot of misconceptions. There's parties that most people have no idea about. A lot of misconceptions about SWIFT and how it actually works. SWIFT does not move money. It's a messaging platform. It connects corresponding banks with payment intents. The cost structure, the delays, and the genuine strengths of this will be examined in the next section here. Next slide, please. The correspondent chain. There's the originator. In this case, we're using an example of a nurse from the Philippines using a small community bank in Houston to send money to her family in the Philippines. The originator is the sender plus their community bank. That payment is sent to a correspondent bank. The correspondent bank routes the money through an FX settlement process. It ends up in a Philippine bank, in this case, the large correspondent bank, and then it's forwarded to the individual or rural recipient bank. Each of these hops has a lot of duplication. They also have their own cutoff times, banking hours, holidays, compliance reviews, and each step comes with its own set of fees. Next slide, please. Again, to iterate, the money in international settlements does not move through SWIFT. SWIFT is the messaging layer. Currently connects about 11,000 institutions in 200 countries. SWIFT is currently migrating to ISO 20022, which is a new standard that a lot of blockchain projects are seeking as well. And this comes off of an older proprietary standard. This standard will allow much richer messages and compliance data to travel with the transaction message itself. So almost all payments between correspondent banks are happening within a day today. It used to take a couple days. Almost half happen within the first 30 minutes. So this is quite a dramatic improvement from just recent years. But I want to add that the choke point is both a bug and a feature. In traditional payment rails, the compliance happens in the path. It happens as the transaction is moving through the path, and it's slow on purpose, I believe, and that allows the transaction to happen while the compliance is happening after the fact. Next slide, please. Where the time goes. So we talked about cutoff times and business days. When you go trans-border, this increases quite a bit. You've got, in addition to business hours, holidays across multiple continents or countries, you've got time zones. You've got compliance holds. And you've got FX batching and intermediaries between correspondence banks and FX providers. This time delay can go from a swift message that could settle within 30 minutes to originator, correspondent bank, FX, foreign correspondent, and the foreign settlement bank, each adding up to a business day in between each step. Next slide, please. Where's the money spent? In a wire transaction, the origination cost is often at least $25 up to $50. So for a small payment, that can be 20% or more. Intermediary fees or lifting fees, these are the cost per hop of each correspondent bank. At a minimum, there's typically 2 correspondent banks for emerging markets. For smaller currency markets, there could be additional intermediaries, each taking $10 or more per hop. There's the FX spread. So if you're going between currencies, that's the spread that's going to be made by the foreign exchange provider. And then there's beneficiary fees. So the receiving bank may charge a fee for receiving the wire. The hidden fee, the one at the bottom, is probably the biggest cost to society, and it's the one that no one ever sees. The Nostro funding accounts are correspondent banking accounts that have funds settled, parked, waiting for foreign correspondent transactions. I've seen estimates, I may have a slide that has it, $4 to $5 trillion is sitting parked to settle fees, settle transactions that are waiting to happen. This is an enormous cost to the market. It's parked capital, it's unusable, and it's sitting at rest, causing the hidden tax. Next slide, please. Diving deeper into that, the pre-funded liquidity, like I said, it's $4 trillion or more. A global correspondent bank could have as many as 500 correspondent accounts, all pre-funded, all sitting idle, all having its own administrative overhead. Interestingly, the BIS says that since 2011, there have been a 25% decline in correspondent relationships, which tells me that there's probably less competition, potentially more friction, and probably more centered on large markets. Next slide, please. What the wire does well: legal finality and recourse, for one. So there's decades of laws on how the existing system works. In some cases, monies can be recalled. There's liability rules, there's deposit, there's court history, and oftentimes there's deposit insurance on either side. Reach. Over 11,000 institutions participate today. 200 countries are covered. There's no other network on earth that reaches that scale. Correspondence, or rather compliance, is built into the path. The choke points, the time delays that we saw are built into the system. It's imperfect, it's slow, but it's comfortable for the regulators. Liability is well understood, and the compliance is built into the path, like I said. Bank money, not issuer money. So in the stable market, you're dealing with often newer startup companies, less regulatory and legal certainty, versus the traditional wire is often drawn on regulated bank currencies, potentially insured bank deposits. There's no depegging risk, no bearer asset custody problems that you see with the stable market. Next slide, please. How stablecoin transfers work. So we took a look at wires. Now we're going to dive into stablecoin transfer. And for clarity, by stablecoin, I mean a blockchain-issued token designed to hold par with a fiat currency such as the US dollar, and it's backed by reserves held by the issuer of the token. In the US, the two dominant players are Tether and USDC Circle. There's also the Wyoming Frontier stable token. We're going to go into the mechanics of how they work and the numbers of where we are today. Next slide, please. So, one ledger as opposed to 5 ledgers in the previous example that we saw, where there were correspondent banks, recipient and sending banks. On the payment, on the stablecoin rails, there's one ledger, the blockchain ledger. It starts with the minting of the issue of the tokens or the issuing of the tokens. Minting process should follow the deposit of fiat currencies. Those are used to back often treasuries, short-term repos, et cetera, that will support the redemption of the token. The transfer, this is a simple blockchain-based transaction, happens in seconds, typically, and it's publicly verifiable on an open immutable ledger. The redemption is the opposite of the minting, so this would be going back to the issuer and receiving $1 back for the dollar deposited. In this, you'll see there's no correspondent change, there's no intermediaries, there's no pre-funding accounts, there's no cutoff times, there's no business days, there's no holidays. The blockchain never sleeps. Next slide, please. So the total picture of a cross-border transaction, the on-ramp where the US dollar, in this case, is exchanged for the token. There's typically small fees, 0.1% or more. The on-chain transaction typically happens for sub-cent in a lot of blockchains, maybe a few cents in some blockchains. The off-ramp transaction, so this would be a local exchange in the receiving country. And then potentially the last mile. So if to move these stables into a local bank account, you might use an exchange process. More and more, this is not the case with Cash Apps supporting stables and so forth. There's more and more, there's not a reason to off-ramp or to go back to traditional deposits. Next slide, please. So the new numbers. Most blockchain transactions are settled within seconds. On-chain transfers cost, here I use the example of 5 cents. It may be cheaper than that. The blockchain, it runs 24/7, 365, no holidays, no weekends, no business hours. And it's 100% visible. In the previous chain that we looked at with the wire transaction, you have almost no visibility between sending and receiving. You have no idea what the state is in between. Oftentimes, you don't know what the costs are in between. Here, the cost can be estimated ahead of time, and the transaction is visible. Tracing funds on chain is dramatically easier. Imagine the process of trying to subpoena those 4 correspondent banks and intermediaries, FX providers, to find where a transaction went versus the blockchain, where it's all immediately visible 24/7. Next slide, please. So this is no longer hypothetical. Estimates for last year were $250 billion in stable transaction in cross-border payments. I'm sorry, that was outstanding. In settled volume, it's in the low trillions. There's a lot of different numbers out there. Not all stablecoin volume is transparent as an exchange between 2 parties. You can send yourself money. You can have various wallets. So, but it's all the estimates are in the trillions per year. Stablecoin settlements recently outpaced ACH transactions in the U.S. And it's the number one avenue for cross-border remittances in several jurisdictions, and it's growing fast in emerging markets. Next slide, please. So the scoreboard so far, the blockchain, the stablecoin settlements give us settlement in seconds versus hours or days potentially. Transparency, the stablecoin transaction gives us public traceability, and the payments themselves can carry logic, so stablecoin transactions can have programmable logic, programmable compliance. Cost. So the average cost is, here we've got between 0.5% and 3%, and I'll give you some caveats on these numbers when we're done. Whereas the average cross-border wire is 6.3%. The lack of trapped capital. So we looked at least $4 trillion trapped in cross-border settlements in Nostro accounts and waiting in correspondent banks for third-party settlements. Next slide. So the honest comparison, we're a long way from wide stablecoin adoption. There's definitely some advantages. There's a lot built into the current system, the compliance, the liability, and so forth. So across 8 dimensions, we're going to look at an honest comparison. Next slide, please. So speed, 1 to 5 business days versus seconds in the stablecoins. Cost, an average of 6.3%. For large B2B transactions, you're looking at a fixed price typically of $25 to $50. In stablecoins, we're looking at about 0.5%, up to 3%. Again, we'll go to that caveat. Availability. Traditional wires are done during business hours, cutoff times, holidays, etc. The blockchain works 24/7, 365 to process stablecoin transactions. Transparency. The traditional wire, there's no visibility in the process, even oftentimes among entities in the flow. There's no transparency outside of the section of the transaction that they see. The stablecoins are settled in public on a public ledger. Every hop is visible immediately, real time. The reach. So this is where the traditional wire wins out. Supported in 200 countries, 11,000 participants. It certainly has the reach and the current relationships in the banking system. On the stablecoin side, and this is where I'll get into that caveat I mentioned earlier, it depends. So I think we'll soon see a time where we don't talk about on-ramps and off-ramps. I think people will maintain some of their finances, some of their funds in stables. There won't be a need to off-ramp. If someone pays you in stables, someone else will accept stables. There's also the proliferation of cash apps that are now accepting stable transactions. So the availability to spend funds without going to a local bank, without off-ramping, without the exchange fees, I think that is a short-term issue. Recourse, another place where the traditional wire wins out quite a bit. The ability to recall. Blockchain transactions are reversible. Most stablecoins allow freeze and or seize by the issuer, but that's often downstream of court actions, etc. Whereas the traditional wire can stop things in process. There's liability, there's court and legal precedent that's been set. Compliance and accountability. So the traditional wire, each hop is a licensed party. There's liability, sometimes there's insurance, and so the compliance accountability at least is offloaded to a third party, right? Whereas if you're accepting stables, you might be accepting that liability yourself. Also, with stable coins, there's only compliance at the edges. It's only when it touches a third party, a regulated institution like an exchange as an example. Asset risk. So bank asset liability is pretty well codified. The court systems are pretty good at bankruptcy, at claims, at settling claims, and so forth. Also, most, at least small denomination deposits are insured in the United States and often elsewhere. For the stablecoin, there's not necessarily an insurer. Most funds are not insured, but most regulated stablecoins have a reserve requirement in the U.S. Under the Genius Act. Stables will be at least 100% reserved. So I'll leave this one up to you to pick the winner. Do you want an insurance claim or a fully reserved asset? You could decide which one's riskier yourself. Next slide, please. The cost. In the wire, each step along the route increases the cost, flat fees, per hop, what they call lifting fees, FX spread, and beneficiary fees. Costs scale with the number of institutions, not with the payment size. So cost gets larger if you're going into smaller markets, emerging markets, etc. It's opaque. Oftentimes you don't know the exact cost until it gets there. After FX, you may not know what funds are going to get to the destination at all. The timeline on the wire side has improved dramatically. It went from up to weeks for international settlement to days. But although it's still improving, it's far beyond what we expect in modern settlement. Stablecoin, the costs are pushed to the edges. So like we talked about, it's the on-ramp and the off-ramp are the only friction points today. And that's where the cost is incurred. The transaction itself is often in pennies. And the fees are transparent, they're predictable, and they can be estimated before the transaction's sent. It's upfront and it's machine calculatable. There's no third party, there's no variation to change that cost. I'd like to mention that the cost of on-ramping and off-ramping is significantly decreasing. So as we see more exchanges, as we see other parties come into the mix, like your money service providers, your PayPals, your Cash App type on-ramps and off-ramps, it's getting much cheaper. There's more competition. Next slide, please. So speed. So this argument's coming down to some degree. Like I said, the median time for correspondent bank settlement has come down to about 30 minutes, although they often take more than a day. So the median is not near the potential time you could wait. But between each hop, you can expect delays in business cycle, in holidays, et cetera, to increase that to days and potentially weeks still. On the stablecoin side, like we said, the settlement's in seconds. The friction is on the off-ramp, that last mile to your local bank to be able to spend your stables. Even though that the tail of the stablecoin corridors, the settlement may take another day, another hop, the settlement is verifiable, public ledger, and real-time settled. So it's a clear winner there. Next slide, please. Compliance. So this is where the wire is currently the true winner, and I think this will change soon. We'll talk about it at the end. So permission is woven into the path. There's screening at every hop in the traditional wire. Each party is licensed and regulated party. And this is precisely why it's slow. The slowness is meant for the compliance to happen. It's not real time, it's after the fact. Stablecoins, the permissions are at the edges. Like we said, the KYT is in the on-ramps and the off-ramps, the exchanges. And for peer-to-peer transactions, there's no travel rule compliance. There's no history of where those funds have been, except that it's on-chain and it's traceable, but it can go around the KYT and travel rule implementations today. And that's why there may be more perceived risks. Next slide, please. So the risks. In a traditional wire, there is some risk in between each settlement. The bank fails before the second leg of the settlement happens. There's, the more parties involved, we saw the correspondent bank parties. There's at least 5 parties in every transaction. Each party adds increased risk. The credit exposure risk, fraud risk, etc. Also, I'll mention that with your traditional wire payments, SWIFT enabled payments, we're seeing sanctions used kind of as a geopolitical weapon. That cuts both ways. It cuts off liquidity. It provides uncertainty to the traditional banking system. And it challenges the position as the U.S. Of the U.S. as a reserve currency. On the stablecoin side, there's the risk of depegging. We saw in 2023 when SVB Bank failed, USDC broke its peg to 87 cents. So it's a 13-cent hit there. During that period of time, your stables aren't as fungible. The value is more uncertain. We don't see that type of individual deep asset depegging with traditional bank payments. Issuer and reserve quality. So in the stable side, your risk is in the issuer's solvency and the quality of the reserves, typically not bank-insured funds, so there's inherent risk there. Key custody, it's a bearer asset, so you can lose your crypto keys just like you can lose your car keys. There's inherent risk with custody there. And then there's the smart contract or the bridging risk, the risk of the software in between the smart contract itself being exploited, a bridge, custody wallet being exploited. And these same issues exist, of course, in traditional payments, but not, but you don't bear the risk as the holder, typically. Next slide, please. When it goes wrong. So when there's a problem, who's the winner here? So in the traditional wire, there's procedures for problems. There's procedures for missent funds. There's potential to recall funds. There's liability allocated by law. So we understand the court's take on funds moving inside the banking system. It's very well settled. As well as the fact that there's often deposit insurance for these things. The cost, clearly, the wire is the more costly option, but that's because the burden is in the process, and the costs reflect that. On the blockchain side, transfers are irreversible. So that's part of a risk, but it also reverses the settlement risk. There's fat finger problems. We recently saw a stablecoin issuer inadvertently type 300 trillion instead of, I think it was 30 million that they were trying to issue. Scams, hacks, and so forth, right? We've seen more and more of that rise, and a lot of people were, look at that and think that blockchain is increasing risk. I look at those and I see it hardening. I think the technology is hardening every day, and with each and every issue that is overcome, it gets more and more hardened against potential failures and exploits. And then finally, the programmability of the stablecoin, compliance-gated transfers are coming. We're going to see more and more of that in the future. With Wyoming's Frontier Stable Token, we do real-time checks against sanctioned entities. And I think you'll see on the private issuer side, you'll see even more scrutiny than that. We're also looking at real-time reserves attestations. I think in the future, you'll be able to subscribe to your money to know how your money's doing. My money's fully reserved. It's not been sanctioned by any jurisdictions, it's et cetera, right? It's all going to be programmable, real-time, and compliance-gated transfers. Next slide, please. So the regulatory map, across the world, we're seeing regulations shape up for stable coins, or e-money, as they're called in some places, as well as the digital asset landscape in general. In the United States, we have the Genius Act, and that's coming into play over the next couple of years. In Europe, you've got MiCA in place, and I think more regulations are coming on board with that in the future. Asia, you got Singapore, Hong Kong, and Japan. UAE have all started licensing regimes, and this list is probably way out of date by now. And of course, you've got Wyoming with the first US-based public issuer of a digital asset. Next slide, please. So, where did we end up? We talked about the risks, the honest comparison, the cost. There's no clear winner. I think it's going to continue evolving. I do think that the blockchain-based solutions will eventually be the winner, and I think that you'll see traditional payments fold into those. You won't even know the difference. But for now, there's the potential of a hybrid pattern. We'll talk about that in a second. It can dramatically speed up the process while keeping the existing compliant rails on the ends. A decision framework. How do you know when to use what payment type, and what are the key factors there? And then we'll talk about the missing layer. Next slide, please. The hybrid approach. So like I said a few slides back, I think in the future we'll see a stable coin market where you won't come in and out of stable coins. Today, the only reason for that is you receive stable coins, but you can't spend them, or you need to spend stable coins, but you don't have them. In the future, I think we'll use it just like another bank account. But in the meantime, there's the stablecoin sandwich, which is using fiat on both ends and using a stablecoin in the middle. And that gets rid of that the two correspondent banks as well as the FX provider. The next emerging thing that we're going to see is banks themselves becoming issuers. So I think there was the OpenUSD was announced this week, and I believe there's 140 potential partners. Some of those are banks themselves. So as we see more and more banks becoming the issuers, the on and off ramp problem will go away. It'll just be transparent. Your money will be fungible between deposits in a bank and taking stable coins off the bank. Finally, in the emerging hybrid world, SWIFT is working on a shared ledger and tokenized settlements. And SWIFT is not actually the payment providers, my understanding. They're, again, the messaging layer. They are supporting blockchain transactions by their corresponding entities. So that'll probably be a dramatic improvement in that process as well. So when would you choose a wire? When recourse is your main concern, when liability, litigious counterparties, when there's no availability to on-ramp or off-ramp, a wire would be the way to go. When choose a stablecoin, when speed and cost are the determining factors, recurring B2B settlements. So in correspondence that you don't have to KYB all the parties all the time. It's recurring settlements between known entities, trusted third parties. It's a great option. When urgency matters, so we saw at the beginning of the Russia-Ukraine war, a lot of funds were being sent via blockchain because urgency mattered in getting supplies paid for. Like, this is kind of a repeat of what I just said, de-risk routes, so between trusted third parties, and then finally when third-party verifiable transparency is the key. Next slide, please. The missing layer. So what comes next? So I personally believe that every shortcoming that I mentioned with the blockchain stablecoin path will soon be overcome. I think that we'll see travel compliance that travels along with your money. It'll be programmed into the money. It will be real time, and it'll get rid of most of the issues that we've discussed today. So we're going to see gates at the transfer, so money will not transfer to a sanctioned third party. Money will not be able to be off-boarded into a sanctioned jurisdiction. We won't have to do this manually. It won't have to be done by every party. It won't be done after the fact. It'll be done real time. It'll be programmed into your money, and it'll be continuous, or at every transfer. And then the continuous attestation, I think we'll get over the idea of reserves uncertainty, lack of transparency, and depegging risks. So I believe that continuous reserves attestation and compliance state will be on chain. It'll be machine readable. You'll be able to program your wallet not to accept uncompliant or unbacked currencies. And to that effect, the Wyoming stable token is now, we now publish daily attestations, and it's not a chart. It is down to QSUP's tenure, maturity of every asset that we hold on a daily basis. And it's only daily because that's as fast as they could give it to us. So it would be sooner than that if we could. Next slide, please. So 3 predictions. I think that we're going to see a double-digit share of B2B cross-border payments settled in a regulated stablecoin in the next 4 years. The correspondent count will continue to fall. So I believe that intermediaries will not survive based on their need for regulatory compliance. I think that that will be built into the asset. I think that to be an intermediary or a correspondent, you'll have to earn your value, and the value will not just be in the friction, but it'll be reducing risk or adding transparency to the process. Compliance will become a part of the transfer state of the asset. So the asset will not transfer to a wallet that is not compliant. It won't go to a jurisdiction that's sanctioned, etc. Next slide, please. Thank you very much. We still have 10 minutes or so available. If anybody has questions, please. Thank you very much. Oh, yes, please. I'm having a little bit of trouble hearing you, but you're asking about the reserves backing? Oh, is that right?
Yeah, the reserves backing, but also maybe the difference and similarity between the Wyoming stablecoin and CBDCs.
Oh, yes, absolutely. Thank you. Yeah, so there's a lot of concern about CBDCs, sorry, central bank digital currencies. There's been a lot of accusations about Wyoming's launch of a digital asset and how that could relate to a CBDC. As a sovereign issuer, there are a couple things that are quite different than a private issuer. So our terms of service looks a lot more like the Constitutional Bill of Rights than private issuers' terms of service. So in order to seize assets, it would take a court order. We can't just, do that willy-nilly, right? We're legislatively mandated to seek over collateralization. So we will eventually be over-collateralized as compared to private sector like Genius Act-based. One of the big differences between us and CBDCs is a stablecoin is 100% reserve-backed. So we have to have the physical assets 100% backing our token, unlike a deposit token, which would be based on a fractional reserved bank deposits, or a CBDC, which would be a debt-backed fiat-based currency. So we are based on the U.S. dollar, but we have 100% reserves or more for every dollar issued. You're welcome. Any other questions? Thank you.